Gold, you merely matched the prior bull markets to be 8,000 to 9,000, merely matching those bull markets. With these conditions out there, it wouldn't shock me to see gold at 10, 20,000. I don't have a prediction on where gold's going, except to say it's at least going to do a ho-hum replication of the prior two bull markets. Eightfold, okay. Now, silver is the most explosive market I can think of right now in terms of upside potential. And we've been arguing this for a couple of years. Silver merely catches up to lead, zinc, steel, aluminum, gold, and they stood still. Those markets stayed where they are now. Silver could go up to $500 or so. It wouldn't shock me.
Global financial markets are nearing a massive pivot point as unsustainable debt levels trigger renewed currency printing. Investors face an urgent need to protect their wealth against accelerating fiat depreciation. Michaeloliver, the founder of Momentum Structural Analysis, points out that hard assets are positioned for a historic repricing event. A standard continuation of prior bull market cycles places gold between $8,000 and $9,000, while severe systemic debt turmoil could easily propel prices toward $10,000 or $20,000. Meanwhile, silver represents the most explosive upside potential across financial assets after breaking out of a multi-decade base. Adjusting for money supply expansion and industrial metal catch-up targets set silver near the $500 mark. Severely undervalued mining equities offer immense leverage as capital flees traditional equities and troubled government debt. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If you look at gold long-term, by our metrics, it made a major bear low in 2001 and 2 at a price of about 260. It had been 850 in 1980, and it pulled all the way back down to there, made a long base, 2001 and 2, and then made a 10-year bull market that took it up to 1920, an eightfold move. But in the middle of that move, at $1,000, $750 off the bear low, and about another 900 to go on the upside, gold decided to have a corrective pullback. It happened to coincide with a puke month in the S&P. Now think about this. The S&P topped in October 2007. Gold was already going up at that time. And the S&P would drop for a full year, and it wasn't until October 2008 that finally the S&P had what you could call a crash month. It had a 30+% drop in 1 month. At that month, gold said, I think I'll have a correction too. It hadn't had one in a while. And it had a very rapid, very bad month that took us from over 1,000 down into the 600s. At that point, the next month, Bernanke came out, panicked as hell, and took a page out of the Japanese playbook and instituted QE, November 2008. Stock market kept going down until March 2009, so the QE didn't help the stock market. In fact, there was a lot more to go. Gold reversed immediately and was back to the highs within months and on its way to 1900. And meanwhile, the S&P never got back to that 2007 high until I think it was 2013. Okay, for years. So there was 1 month in there, therefore, when gold did go down with the stock market. Everybody thinks, oh, well, see, that's what's going to always happen. Go back in history, 2000 to 2002, dot-com collapse. S&P went down 50%, NASDAQ 100 went down 82%. Gold rose during those 2 years and continued on up through 2008. Then there was the 2008 collapse, that 1 month, but then it continued on up. It was basically that collapse where the stock market was in the middle of a bear trend, and gold had a 1 month drop, and everybody thinks, oh, see, therefore it follows stocks, okay? Well, how come if stocks just got whacked this week, big time, pretty good whacking, on this new news, the gold miners exploded. Nobody's commenting on that, okay? And you go back, way back in history, 2007 to 9, as I said, the bear market stocks, gold rose during that period. Yes, it was a bad month. Go back to 1929 to 32. Another massive bear market. Stock market went down 80% during that 2.5 years. You couldn't buy gold because it was illegal. They banned it. But you could buy gold miners. Homestake mining in particular went up like 1,000%. Well, the stock market collapsed. I mean, I guess it didn't get the message. You're supposed to go down with the stock market. Okay, you get the point. Gold is an alternative asset category. So when the house catches fire, all the money doesn't get burned up. The money flees. A lot of it flees, and it goes to alternative categories. But when you look at the gold miners and silver miners, they are vastly undervalued, but they're also tiny as an asset category. So it doesn't take much money fleeing the stock market to goose that wet bar of soap straight up, okay? So that's what I think we're beginning to see. Now, I'm not sure where I think gold is going to go. By the way, we can use that as a first metric, and therefore if gold's going up this amount, then maybe the miners will go up twice that amount, right? That's what that spread suggests. If you look at gold's history, the bull market peak in 1980, after a bear low in 1976 near 100, you went up to 850. It was an eightfold move. It took 3.5 years, okay? Then 2001 and 2, you had an eightfold move to 2011. Different duration, but also an eightfold bull market. We were only fourfold because our bear low was 1,050 in 2015. So we're only half as much up as the two prior bull markets on a percent basis. And yet we have these events that have been percolating on the sidelines and nobody's recognized the government debt crisis globally. And suddenly, and the T-bonds, which used to compete with gold as an alternative, not being a place to be. So if gold merely matched the prior bull markets, it would be 8,000 to 9,000, merely matching those bull markets. With these conditions out there, it wouldn't shock me to see gold at 10, 20,000. I don't have a prediction of where gold's going, except to say it's at least going to do a ho-hum replication of the prior two bull markets. Eightfold, okay. Now, silver is the most explosive market I can think of right now in terms of upside potential. And we've been arguing this for a couple years. Silver's value to gold is off the page, low. Silver was stuck in a price range for 50 years with two highs at $50. In 1980, when silver was 50, gold was 850, okay? Gold right now is where? 4,600, let's say, versus 850. And yet silver's only trading $16. No, excuse me, it's about the 70, so $20 above its 1980 high. That's trivial. Look at copper, steel, lead, zinc charts going back to the 1980s. Most metals made highs around that time. They're trading at 4 times to 6 times where they were that number decades ago. How come silver's only trading a small percent above its 1980 high? Gold's 4.5 times, et cetera, et cetera. Silver made a mistake. Now, maybe it was arbitrarily done by intervention, manipulation. I think that's probably true. But that didn't work because silver broke those restraints late last year when it blew through 50. So it said no more. And I think if silver merely catches up to lead, zinc, steel, aluminum, gold, and they stood still, those markets stayed where they are now, silver could go up to $500 or so. It wouldn't shock me. And also, if you look at the money supply, M2, you go back to 1980 and see where M2 is now, how much more money has been printed. Factor that into the price of silver versus 1980, you come up with something like $500. That's a to-be expected norm, in my view. It's not my target. I frankly think when a market has been overdone, either upside for too long and too high, and it collapses, like, let's say, .com did, 80% drop then, like 2000 to 2002 in .com. And yet .com was a true statement. It really did change our lives, and yet they collapsed 82%. Silver has been oppressed for 5 decades, okay? 50 years. 46, actually, okay. But if it's been an error, quite often when markets make errors, they overdo it in correction. In other words, if they're too low for too long, they don't just go to what might have been a norm. They overshoot it in an emotional burst, especially when you've got the situation now where there's no other alternatives. If the stock market starts now to break, the bond market's highly in question, where are you going to go? You get the point. It could be a wet bar of soap phenomenon for the miners and for silver versus gold.
Decades of historical market data prove that tangible wealth frequently decouples from broader equity downturns. During both the 2000 .com bust and the Great Depression, smart money abandoned failing paper indices and sought refuge in alternative monetary reserves and mining shares. The Federal Reserve now faces an insurmountable dilemma: soaring consumer credit defaults, banking fragility, and commercial real estate stress make high borrowing costs fatal to economic stability. Continued balance sheet interventions and liquidity injections steadily hollow out the purchasing power of paper money. as rising yields destabilize government bonds. Institutional capital will swiftly seek shelter within physical asset categories that carry zero counterparty risk. Now, let's get back to the interview.
Fed raising rates, that's exactly what they don't need to do right now. They're trying to keep long-term rates from rising. Why? Because they know what we know when we look at the financial sector, that it not only has implications for the government having its debt crisis, but there's a lot of private debt out there that is in jeopardy. We know that. We know that credit card limits are past due more than ever before. This is worse than 2008 already. There's a lot of debt out there. Commercial real estate debt is enormous. They can't take long-term yields staying high or going higher. And the Fed knows if they stay up there or go higher, you could have a burst, suddenly news headlines. What does that do to the market? Well, you know what it does. It reverses thought process and emotion immediately. No more gradual this and that. It's suddenly, I've got to get out of here. So they know they can't raise rates really. And they can talk about walking the line and looking at the data. The main data they got to look at is their bond market. It's not a mandate, but it's the house on fire. Okay. So, and when they print money, that's the real inflation. People talk about inflation as CPI or wholesale prices. That's nonsense. That's merely an effect of inflation. Inflation is the increase in the money supply and the degradation in the buying power of the money unit. Whether it's the dollar, the euro, the yen, the UK pound, doesn't matter. They're all in the same boat. They've been printing money for decades. There's nothing behind it, and it's an upward curve printing process. Look at an M2 chart, you'll be so impressed. You'll say, gee, I wish I'd owned that. Okay. Upward parabolic bull market. And when you look at assets, like, well, when your granddad built a house in the U.S., if he were here, it was $4,500. When your dad built one, it was $45,000. Median home now is $450,000. What does that say? The degradation in the money unit. Okay, so commodities as a category, which is where you get the CPI and the wholesale price stuff, is merely a reflection of the decay of the money unit. But it's an undervalued category right now. When you go back and look at history and measure, let's say, the Bloomberg Commodity Index, which is a basket of pretty well balanced basket of commodities from energy sector, grains, soft commodities like sugar, cocoa, coffee, cotton, copper, lead, and also includes the monetary metals as a reasonable percent, not overweighted. That was at 235 back in 2008 when commodities peaked then. They dropped to under 60 in 2020. So in 12 years, they went from 235 to under 60 on the Bloomberg. I mean, that's like going to go free commodities, okay? No, in late 2020, we put out a buy signal. They had their first surge. They went from under 60, we put out a buy around 70. They went up to 140 by early 2022 and stopped about halfway back to the old high, okay? And then they dropped back down the last couple years to around 100. Okay, so less than half the value of 2008 still. Meanwhile, stock market's making new highs on this. But commodities are still underpriced to themselves and to any other asset category. In October last year, we put out a major second buy signal saying, okay, we're beginning again. Price then was 107. Right now we're trading around 140. No headlines. And by the way, it wasn't oil that got you up here. Oil was a laggard. It didn't break out for our metrics until January, 3 months after we put out our buy signal on Bloomberg. Oil woke up 3 months later and broke out at 65 was our buy signal. The unfortunate thing for oil is that it sucked in amateur headline chasing buyers. You don't buy war news. You don't sell war news. There are bigger things at play here. Oil is vastly underpriced to its own self. I mean, in past prior peaks, 140 and 130. And we're trading right now at 85. That's not even overpriced. And we came up from below at 55 late last year. So you were 55 oil versus old highs at 140 and 130. Okay, so oil was just dirt cheap relative to its own history. And when you plot oil or commodities on a spread relationship to, let's say, the S&P, they're like off the page. It's like we don't need commodities anymore. We're ethereal. Okay, we're not real. Okay, what's going on is there's an asset class shift underway. Commodities are starting to become the recipient of smart money that says, okay, I want out of the higher risk, less reward category, like the stock market. I'm going to move some of that money into a low risk, high potential reward category. It ain't going any lower. It's proved itself. The only issue now is how high does it go and how long does it take? So we argue technically, as of last October, that it's a great place to be in the broad commodity category. It will, this time around, tend to follow gold. It doesn't always, by the way. But I think this time, like in the late 70s, it followed gold. It didn't match gold in the monetary metals, but at least followed. And I think that's a category to look at positively. So that is a reflection not of necessarily at this point shortage of wheat or oil or anything like that. Oil was going to go up anyway because it was dirt cheap. It needed to reprice itself. Commodities are also in the same dirt cheap category. And it was simply the money flow that the central banks create around the world. It went somewhere, commodities. And I think that's another beneficiary or place to be over the next year or two, especially.
The broader raw materials complex is exiting a generational bottom, setting the stage for a prolonged structural repricing. After more than a decade of persistent undervaluation, key sectors across energy, agriculture, and base metals are rebounding from multi-year lows. This ongoing upward momentum is not merely a reaction to temporary supply chain disruptions, it directly reflects the relentless expansion of global fiat money supplies. Raw commodities remain exceptionally discounted when compared to inflated equity benchmarks and actual physical production costs. As global central banks inject fresh liquidity to service mounting public obligations, capital is systematically rotating toward low-risk, high-reward hard assets. This institutional shift creates durable tailwinds for physical resource accumulation, while paper instruments face compounding real depreciation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.